Holy moly, it's been a crazy ride for GameStop this week. The stock was trading at $40 at the beginning of the week, and then on Wednesday, things started to go crazy. On Thursday, the stock was trading at around $180, so if you had timed it correctly, then you could have potentially 4x your money. The stock ended up finishing off the end of the week at about $100, which is still really great if you held the stock. So I wasn't gonna do a video about this, but it's just been too crazy of a ride for me not to do a video about this. So I thought I'd at least do a really quick video just describing what happened, why the stock went up, and my thoughts moving forward. All right, so last week, Jim Bell, the CFO of GameStop, announced that he will be resigning on March 26th. So basically, he's gonna finish out the quarter and then resign. They're going to release their Q4 quarterly earnings on March 25th, and then on March 26th, he is out. I initially processed this as good news. I said in my earlier video that I bet that Ryan Cohen's group is just waiting for either the CEO or CFO to screw up, and then they're just gonna swoop in and take over their spots. I bet that they're just waiting for the CEO or CFO to screw up at this point, and then they can just swoop in and take their spots. And now they are basically one step closer to a Ryan Cohen takeover. But even though Ryan Cohen is not taking over as CFO, one of his partners that sits with him on the board, Jim Grube, might take over as CFO. Remember, Jim Grube was the former CFO of Chewy, so you better believe that he's preparing to interview for that spot right now. Normally, a CFO resigning is seen as a negative, so when GameStop announced that Jim Bell was resigning as CFO, the stock was actually down after hours. It was down to about $42. And I actually wanted to buy at $42 after hours. And I don't know why I didn't do it. Well, I don't really have that much experience buying like after hours and pre-market. So I just wanted to wait until the next day when it was open market so I could just buy then. But when I woke up the next morning, the stock was up like 8%. I was like, oh, damn, I missed my chance. Like, I missed the boat. I didn't expect, obviously, nobody expected that the stock was going to get squeezed at that point. And just throughout the day, it kept going up and up. It was up 20%, up 30%. Near the end of the day, it was up like 35% or something to like something like $60, $70. I was like, oh my God, I can't believe like it's up this high. And all of a sudden, by like the last hour or so, it was up 100% to over $100. I think it closed the day at like $103 that day. And then after hours after that on Wednesday, it was up another 100%. It was at one point it was up to like $170. So I was just so annoyed that I didn't buy the stock at $42 when I had the chance to do it. I could have easily bought 100 shares easily and made $100 per share and just profit 10K from that, but didn't do it. So annoyed. I'm just not sure why it hurts more for me to not make this 10K more than it did when I lost that 13K from investing initially. I think it's just that like I knew that I wanted to buy at $42 and I just didn't. Where the other way, when I lost at 13,000, I just had like an analysis that was a little bit flawed, but the analysis was just fine, so I didn't regret it. So whatever. Anyway, basically what happened was that Jim Bell resigning was seen as a catalyst for another short squeeze, and I know that most people watching this probably know generally how a short squeeze works, but I thought it'd be useful to get into some more details about the mechanics of how short squeeze works, just so that people can gain a better understanding. But first off, I just want to say that I'm not an expert when it comes to shorting. I don't short stocks myself. I know generally how it works, but if you know how it works and I miss something, then just feel free to comment below. So to describe the mechanics of a short squeeze, I have to explain a couple of things. I have to explain what shorting is, I need to explain what margin is, and then I need to explain what a margin call is. So if someone wants to short a stock, they have to borrow that stock first, and then they sell it into the open market. So for example, let's say that person A wants to short a stock, and then person B owns that stock. Person A would then borrow that stock from person B and then sell it to the open market. Let's say person C. That is basically the mechanics of a short. If the price of that stock comes down, then the person who shorted the stock can cover their short by buying back those shares from the open market at a lower price and then paying back those shares to the original owner. So in the same example, let's say person A wanted to cover their short, they would buy back those shares from person C and then give the original shares back to person B. So a short is basically two transactions. First, you borrow the shares, and then second, you sell it to the open market. And then when the short covers, it's also two transactions. They buy back the shares from the open market and then return it back to the original owner. So when someone shorts a stock, they are borrowing those shares to sell to the open market, and that money that they receive from that sale, it's in their account, but it doesn't belong to them. It actually belongs to their brokerage. They're borrowing that money. And when someone is borrowing money from their brokerage, that's called margin. So people have to pay interest on that margin. But that margin is not linked to just the money that is sitting in the account. It's linked to the price of that stock that they shorted. So if the stock that they shorted goes up, then that margin increases and they have to pay more interest. This causes a constant pressure to basically cover their short position, or else the interest fees will continue to rack up. But not only do the borrowing expenses go up if the stock price goes up, the brokerage also imposes what's called a margin maintenance requirement. This means that the person shorting the stock needs to have cash in their account in addition to whatever proceeds that they get from shorting the stock. For example, let's say that somebody shorts 1,000 shares of GameStop at $100. The short value of that transaction is $100,000. Assuming that the stock brokerage has a 30% margin maintenance requirement, then that person is required to have an additional $30,000 in cash in their account. If GameStop then goes to $200, then the short value is now $200,000 because, again, they shorted 1,000 shares and now the stock is at $200 per share. So assuming a 30% margin maintenance requirement, again, now they need to have $60,000 in their account. So they either have to come up with an additional $30,000 in cash in their account, or they need to reduce their short position by covering. This is what is referred to as a margin call. So a margin call basically forces a short seller to cover their short position. And it's essentially a forced buy of that stock because remember, when someone covers their position, they have to first buy those shares from the open market in order to return it back to its original owner. So if enough people are margin called, then there's a lot of people buying those shares. And just because of supply and demand, the stock price has to go up. When the stock price goes up, more people get margin called and the stock price goes up even more. And this is basically what causes a short squeeze. I just realized that I'm being really loud and it's 3 a.m. in the morning. So I probably shouldn't be that loud. Anyways, this is what happened last month when the stock price went to $482. And this is what happened to a lesser extent this week when the stock price went to $180. So is another short squeeze going to happen? Maybe, I'm not sure. But what I do know is that the stock price is not worth $100 from a fundamental standpoint. And even though retail investors own a large chunk of the shares of GameStop, the institutional investor still owns a lot more. They still own the vast majority of GameStop shares. And the institutions, they're going to sell at $100 because it's their job to do so. When the stock price goes far above what they think is the fundamental value, it's their job to sell. And if they don't sell, they risk being fired. So I expect the price to come down from here. On the other hand, there are a lot of catalysts that can cause another, let's say, mini short squeeze, not one that is as big as the one that we saw when it went up to $483. At least that's what I think. But the other catalysts include, let's say, if GameStop is able to raise capital at this price and take bankruptcy off the table, at least for the next 5 years or so, that would be very good for the stock. If Jim Grube is named CFO, replacing Jim Bell, that would be also really great. Or maybe like Elon Musk ends up buying 10% of GameStop shares and he joins the board. So that would be crazy. And anything can happen. Who knows, right? So if the stock goes under $50 or so, I think I will be a buyer at that price. At least I'll buy a little bit. Like I said, there are a lot of catalysts that can cause another spike. So not financial advice, by the way, just telling you what I would do. I can for sure be wrong. I've been very wrong in the past in terms of the stock price movement. So I probably will be wrong this time too. Anyway, if you want more GameStop content, then this is not the place to get it. I will be doing more GameStop videos, but this channel is not going to turn into a GameStop channel. So if you like my content in general, then feel free to subscribe to this channel, give this video a like. My next video, I'm going to go over the Airbnb Q4 2020 earnings. So stay tuned for that. As always, thanks for watching, and I will see you in the next video.